Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakaya and our guest on the show today, Mahesh Nandurkar, Managing Director and Head of Research at Jefferies. Mahesh is a veteran of the market and has been tracking India for well over 2 decades now, probably closer to three. But Mahesh, great to have you on the show. And it's an opportune time because you've just come back from a fortnight with roadshows in the United States where presumably you've met a lot of the old India hands and the big investors. So you're in the right place to tell us what the mood on India is at this point in time. Is it still very negative? Should we expect much more of FII selling in the months to come? Or did you come away with the sense that much of the selling is already done, not much to go?
Thanks, Udayan, and thanks, Abba, first of all, for having me here. It is just to correct you, then 2 decades, not three. Although I've lost a lot of hair, but it's still 2 decades. Anyway, to answer your question, yes, it's been a sort of quite interesting set of meetings here with the US based investors. And what I can say is that, while India has seen a lot of foreign selling already, as you rightly mentioned, we've been seeing almost like $5 billion a month kind of a net selling by the foreign investors over the last several months now. And we've seen more than $30 billion selling in the last 6-7 months. But to put that number into the context of overall FII investments here in India, that's like more than $600 billion. So what we've seen, is still, only a small part. And the sense that I get, then is that it's not necessary that this selling can come to an end pretty soon. I'll not be surprised if we see some more selling going forward. The reason is that the valuations of the Indian markets on a relative basis are still on the higher side. If you look at it from the emerging market and the Asia ex-Japan kind of a context. And while India always trades at a premium, but the current premium is much more than the average, primarily because of the low valuations in China. And so that's one reason, which is the valuation. And secondly, at a slightly more broader level or at a global level, with the rate hikes in the US, the way they are going through, and in the rest of the world as well. And I'm sure there'll be more rate hikes in India as well. That's not exactly a very conducive environment for equities. So to answer your question, I'll not be surprised if selling continues for some more time.
This is an interesting point, Mahesh, because a lot of your peers seem to be suggesting that the PE correction has happened in India. Now, whatever has to happen will probably be led by earnings downgrades. But you think that there is still room for PE contraction in an absolute term? I mean, price earnings multiples led by things like sentiment, technical factors like global selling, etc. Do you think that can bring down the PE notch for India even further from the correction that we've seen already?
Yeah, I do believe so then, because, when we talk about average multiples, the multiples move on either side of that line, right? And, for the last several years, we have been on the higher side of that line. And we are now coming towards the average. But given the global backdrop, I will not be surprised if we move on the other side of that line. That's my kind of a limited point. And also, as I mentioned earlier, there is clearly a search for value trade going on in the world, and especially with the policymakers in China seems to be giving some indications towards that policy easing part, which has the capacity to attract more equity capital or more flows. But having said that, I must also add that I'm very positive and I'm very constructive on the Indian economic outlook, the corporate earnings outlook. I personally believe that while the rest of the world and US and some of the other major markets are going through the periods of recession driven by the much higher interest rates that's now prevailing, I believe that India actually has a much lesser downside on the earnings growth, on the GDP growth, because of the higher interest rate environment, because I believe that the Indian economy is at the cusp of a potential uptick. And if it wasn't for the global headwinds, I think the GDP growth would have surged much more.
Mm. Now, this brings me to my next question, which I was going to ask anyway. So, you are not in the camp which believes that earnings downgrades will follow now, because first the market fall happens, and then there is some denial about earnings and whether they will go down or not. But inevitably, the earnings downgrades begin to creep in. But if not in FY23, but certainly in FY24. And we saw probably the first glimpse of that in the quarter gone by. Do you think that that is a risk, or do you think we'll get away light with earnings cuts this time?
Well, yeah, we saw some element of downgrade, but that was a very small one then, and nothing as compared to the typical earnings downgrade cycle that we've seen in the Indian markets for most part of the last decade. Where during the course of the year we've seen downgrades to the tune of 10 percentage point to 20 percentage points in many of the years in the last decade. Whereas the cost pressures that we have been seeing globally started off with the coal prices going through the roof in the fourth quarter of last year, maybe the second half of the last calendar year, and then the oil prices going up, the metal prices going up, etc. And oil obviously continues to stay at an elevated level as we speak. The metal prices have definitely rolled over. And I believe that the Indian corporates have shown great resilience to this. They've been able to take adequate price hikes, and yes, those price hikes have been, have resulted in the volumes contracting, especially in the price-sensitive segments, the low ticket price sensitive segment. But by and large, the earnings have held up well so far. And yes, I will not rule out small downgrades going forward, but I'm not anticipating large downgrades.
Mahesh, we're in the midst of a rising rate scenario, and I want to understand better what you feel the implications will be on some of the domestic pockets. You've talked about how perhaps you're seeing value emerging once again in auto. Is that something that you're still looking at, and what's the rationale there?
Yeah, the rising interest rate scenario puts a lot of investors in the cautious mind, especially globally. And I mean, if I can just give you the example of how it's playing out in the US, the mortgage rates in the US have gone up from anywhere between 1.5 to 2%. That was the case, say, 3 months ago. Now it's almost like 5 to 6%. And mind you, most of the borrowers in the US go for a 30-year loan. And these are the fixed rate loans, unlike in India. So in the context of a typical US, household buyer or a mortgage, seeker, the monthly or the EMIs have gone up by almost 40 to 50%. That's a huge increase. And that has, almost put to a standstill the housing market in the US. But that's not the case in India. I mean, first of all, our starting point of interest rate is much higher at about close to 7 percentage points. And our mortgage rate will probably go up to, let's say, 9%. I don't think it's, go up by as much as what we've seen in the Western world. The second point is that our interest rates are typically, the tenor are typically 15-year and not 30 years. So all these things put together, the AMIs don't go up as much. I mean, our estimate, it'll go up by, say, about 20% or so. And anyway, these are variable rates. So, by borrowing, say, 6 months before, you could, save your interest cost by 6 months. But ultimately, because it's the variable, rate loans, the interest costs catch up with you anyway. So the point I'm trying to make here is that, the housing market, which is supposed to be, very, very sensitive to interest rates globally, it's not as sensitive here in India. And the second point is that given the state of the housing cycle that we are in, interest rate is going to be only one of the inputs, but the other key drivers are still the affordability and the pent-up demand, etc., etc. So I'm still quite optimistic that we have just entered the second year of the housing market upcycle, which I think will last for another 4 or 5 years, if not more. So that's one of the key reasons for our optimism around the Indian economic growth going forward. But yeah, there will definitely be certain segments that will get impacted more. You also mentioned autos. That's a segment that we like quite a lot. Also, that's typically considered interest rate sensitive, globally. But I guess once again in the Indian context, I do see a lot of possibility of many of the four-wheeler stock delivering good returns from here on.
Okay. You said earlier that you don't expect major downgrades, Mahesh. But the fear of downgrades actually is more in the commodity linked segments because commodity prices have started coming off very sharply this year. But before we talk about metals, perhaps you could tell us what you're doing with many of these upstream oil companies now because the windfall tax has probably led to a scramble to mark down earnings expectations for the ONGCs and Reliances of the world. Do you think that sector will struggle going forward?
Yeah, I think with the latest changes in the regulatory environment and the export tax and production tax, etc., or cess, etc., it has definitely created an environment of uncertainty in the both the private players as well as the public sector players. And my sense is that given how we have seen the situation has evolved. On the marketing margin side, there was an expectation that once the UP state elections are over, the marketing margins will get normalized in due course of time. But that is still awaited. So I think there's also going to be a worry that how long will these windfall taxes remain, and whether even after, let's say, the oil prices has corrected or the refining margins have corrected, whether these taxes will still continue to stay on for some more time after that. We don't know. So it definitely has created some element of uncertainties, in the minds of investors, which is probably going to weigh on these stocks.
What about IT? We are just about to enter an earnings cycle now. The first of the block, as always, will be the large IT companies. There too, there are lots of concerns because of the margin front, demand from the US that maybe earnings will have to be brought down for FY23 and 24. Where do you stand on that?
Yeah, so IT is one sector which has traditionally been viewed as a defensive in the Indian context. So if you are worried about the market outlook as such, this is one of the sector that you typically cling on to because it has all the defensive characteristics, strong cash flows, high ROE, etc., solid corporate governance. But in the current round of the market correction, that has not IT sector has not proved to be a defensive sector. It has corrected quite a lot. And what has been playing on the minds of investors is the correlation with the US economic growth. And if you are looking at a possible hard landing or a recession in the US, how does the IT sector get impacted by that? That's point number one. And point number two is also the correlation with the other tech stocks globally and the NASDAQ as an index. And although one might argue that many of these tech stocks globally are maybe like profitless companies, and the Indian IT companies are highly profitable ones, etc. But still, there is a strong correlation as far as the stock prices go. And I believe that some of these stocks are still trading above their historical average multiples, and that P multiple risk definitely remains in the IT sector. Although what I believe is that the demand outlook is still pretty solid, quite strong, and the earnings are holding up quite nicely. But as you rightly mentioned, it's a sector where it's difficult to make a call, and we have a neutral position on this sector at this point in time.
Mahesh, you've talked about a zero return scenario for the year given the current mix of factors at play. Do you stick with that? And also, what's your view when it comes to retail investors or domestic investors and the kind of momentum that we've been seeing on that front vis-a-vis the kind of selling we're seeing from the FIIs? Domestic interest has so far managed to keep us somewhat afloat, but what do you anticipate going forward?
Yeah, so I still maintain my view that it is still going to be a difficult year, even from here on, to make positive returns. And I still believe that, we'll probably going to move in a sideways fashion from the next 6 to 9 months perspective. And you're right. So far, while the foreigners have been selling at a vigorous pace, the domestic investors have really stepped in and matched the foreign selling dollar to dollar, and has helped the Indian markets to stay reasonably, strong. Although it has corrected in absolute terms, but the Indian market correction still looks pretty, robust, I would say, in the context of S&P correcting by 20% year to date and Nasdaq by 30% year to date. And in that context, India has corrected only 10%. So the domestic investors have, really played a big role. My sense, however, is that we cannot take the strong domestic buying for granted, because two reasons. One is that historically we've seen that when the trailing 12-month returns become negative, typically the domestic investors tend to slow down. I'm not saying they will turn net sellers. I'm just saying that the pace of purchases can slow down. And if the foreign selling continues to stay unabated and the pace of domestic buying comes down, it can create some downside risk in the near term. So that's what my key worry would be. So I'm actually, I mean, maybe to answer sort of one of the questions that Udayan asked earlier, I'm more worried about still the PE multiple part rather than the earnings part as such.
Let me ask you about the bright spot from an earnings perspective for so far, Mahesh. Banks. Banks so far actually for the last many quarters have held out. Their stocks have not been huge outperformers, but from an earnings perspective, they've done reasonably well. Can we extrapolate that into the next 5 or 6 quarters? Or do you think that a lot of the earnings of the last few quarters have actually been because credit costs were declining, the asset book was getting cleaned. But now, once that process is over, those spectacular earnings gains will no longer happen in FY24 onwards. I'm just playing the devil's advocate because so far they have done well. Can they continue to bail earnings out?
I am pretty optimistic on the banking sector. And as you rightly mentioned, credit costs being at a lower level has been one of the key reasons. But I think the credit cost will continue to remain low and will continue to provide the required impetus for the earnings growth to stay strong. So we are expecting close to 20% earnings growth for the banking sector this year. Next year, it will slow down a little bit, but still should be in the range of 15% plus. So that's a pretty optimistic scenario in my view. And on top of that, banks or the banking sector is perhaps the only sector, I would say, where I can be very comfortable about the valuations. I mean, if you look at the large stocks or even the small stocks, in that space, this is clearly one sector which is standing out in terms of valuations not being demanding. So we are quite positive on the banking stocks.
So let me ask you, Mahesh, about another aspect of this retail investor question, which you were answering earlier. But one aspect is when the trailing earnings or the trailing gains start to diminish. But what about the fact that competing asset classes might start to look better in the next 6 to 9 months? So you will probably find fixed deposit rates at 8% plus after a long time. The housing cycle that you spoke to, maybe real estate as an investment class also starts to deliver returns. Do you think that compared to poor returns, trailing returns from equity, might actually also lead to some shifts in asset allocation from the domestic crowd?
Yeah, that's the valid risk factor then. The resurgence of the housing market, the property as an asset class is definitely going to be one of the incremental options which the investors will, be considering, which didn't really exist for the last 7 to 8 years. And yes, the market volatility, is also not, a great sort of, driver for the retail investor participation because, again, historically, we have seen that the periods of higher volatility, tends to kind of, scare the investors away. Deposit rate, yes, but as you rightly mentioned, I think the deposit rates have just about started rising. And for the rates to become any appreciable sort of attraction point for the retail investors. As you mentioned, it's probably going to be, say, another 6 months to 9 months away. But yeah, so that's going to be another risk at the horizon that we will need to keep in mind, although that doesn't seem imminent just as yet. But yeah, but it's a combination of all these 2-3 factors is something that makes me watch very, very closely the trends on the domestic investor behavior, because that's going to be key for the market performance going forward.
Mahesh, while we seem to have come out of the grips of the selling that we were witnessing a few weeks ago, at least for the moment, what do you feel are the possible red flags to watch out for? You talked about sideways movement in 6 to 9 months, but what are the key factors that you'll keep an eye on in this period? Because we're already seeing a lot of conversation and debate around, for instance, the RBI's policy moves, their kind of stance at the moment with respect to growth and inflation, with inflation already pretty much ready to, overtake the limits that have been set by the RBI. And it seems to be already at a fairly risky higher level at this point. They may be compelled even to hike further earlier than later.
Yeah, so in terms of the red flags, apart from the retail investor participation that we already discussed, clearly we need to kind of still keep a tab on the inflationary pressures, and especially which way the oil is going to be moving. Thankfully, so far I would say in the Indian context, the inflation has been much well behaved, much better managed as compared to many of the sort of other countries globally. We have been used to seeing 7% inflation for a long period of time. So the inflation going up to 7 is not as big a shock for us here in India as it probably is for many other economies. But oil is something that we will need to keep a sort of keen watch on, because at the current levels, we are already looking at the current account deficit being 3.5% of GDP, something that we have not seen since over the last 8-9 years. And clearly the capital flows doesn't seem to be anyway close to bridging that deficit, the current account deficit. And we've already seen some fall in RBI's forex reserves, and we anticipate more as we going forward. So that's going to have some impact on the currency as well. So yeah, so those are some of the factors that we need to keep in mind, which can have a market impact.
All right, Mahesh, we'll leave it there. Thank you so much for joining us on the show today. Great chatting with you, as always.
Thank you. Thanks a lot for having me here.
If you like the video, do like, comment, share and subscribe.